strategist Warren Pies. Warren, I want to start off in a slightly different direction. Unaffordability, bad if you're trying to buy a house, but if you own a REIT that's got apartments in it and multifamily, might it actually be good because, hey, you've got more demand from renters?
Yeah, thanks for having me. That makes sense. If you look at basically what's happened with the housing market versus the rental market, we've had both markets have exploded post-pandemic, but you've seen house prices way outstrip rents. So yeah, I think when it comes to the specifics of multifamily, that could be a positive. But I mean, our main point as a kind of a quantitative macro shop is to try to determine, what's happening with the economy. And we've really started to zero in on the housing market. I think housing affordability is, the real housing cost right now. So that's the average monthly payment in real terms is close to $3,000 a month. And so every time we've ever seen house payments get above $2,000 in real terms, we see a slowdown in first home builder sentiment, then construction spending, and finally you get construction layoffs. Now, that's really central to any recession call is construction layoffs. So, Warren, I mean, that's what we're watching.
Is it different this time because inventory is so low at the same time? So even though stuff is unaffordable, maybe home builders are still going to build because there just isn't that much inventory out there to begin with?
Yeah, I mean, I think it's different for a lot. That's a huge differentiating factor for this cycle. I mean, there are a ton of homes under construction, so there's work to be done on that front. It's taking longer to build a home. I think there's labor hoarding because there is a shortage of construction labor. So if you're going to say, how's this cycle play out versus the average cycle, I think it's going to take longer. And another factor on the consumer side is just the amount of stimulus. I think it's really difficult for the average analyst or person on the street to realize how much money got pumped into the economy. And what we've seen, if you go back to the end of last year, everyone thought we were going to come into 2023, have a recession. But reality is when you get a little bit of backup in mortgage rates, you get a little bit of backup or it falling in mortgage rates, falling car loan rates, you start seeing demand accelerate because of that underlying stimulus.
So, Warren, how do house prices come down if inventory is so low? If people don't want to move and sell their house in this environment because they can't find someplace else to live, how do we get that soft landing from better affordability?
I think the way you get the soft landing is ultimately you don't want a soft landing. Almost by definition couldn't require a big decline in house prices. And so we would look at it happening more on the mortgage side. And so we modeled out, okay, what happens during QT? What happens during high volatile periods for interest rates in general? What you see is the spread between mortgages and the 30-year blowout. That needs to revert to historic norms. That would take mortgages down to about 200 basis points. Let's say you get another 5% haircut on house prices as we, obviously continue completing the homes under construction. And then you have just rates moderate in general. And so these are a lot of things that have to go right. It's not our base case, but it's a potential path to a soft landing.